Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to try to make sense of markets that really don't make any sense. For long-time viewers, I do have some good news. The disclosures I normally read around this time, I can now read at the end. As long as I don't forget to do it, we're good to go. So let's talk about the trade war, because you can probably imagine that I don't want to. But we have to talk about the trade war, because they really thought there was going to be an escalation on this Sunday night. I'm actually shocked. It appears that we've backed down. I mean, if you look at the Chinese economy now, look, I'm not saying any of this for political reasons. So if any of you think that, I'm not. I'm just looking at, okay, we did go out to set out for a trade war. The reason I'm a bit surprised we're not pushing it, because it looks like we're winning. And I wanted to look at this from an investment standpoint, not a political standpoint. I thought we were winning because China's economy is growing very, very slowly. They're having a lot of debt defaults in the private sector and a rising number of debt defaults. And it makes perfect sense when you have a contraction in world dollar liquidity, or the amount of dollars floating around the global financial system, and you have tariffs. It's a hard battle for them to win. And it almost seems to me, looking at the global economic data, especially coming out of Asia in general, they just need a little another nudge and the economy would fall apart. And then out of nowhere, President Trump apparently backs off. We're going to have a trade deal that will never be public record. China has requested that the document, whatever it is going to be, if there is one, I don't know, because they'll never see it. So we don't know the terms of it. We just know what we're hearing and what we can actually see happen. And so it makes me wonder, what is the real deal on this? You know, I've said before that President Trump's risk on re-election, again, not trying to be political, it's a recession. Because when the U.S. economy if the U.S. economy ends up going into recession, the statistical odds that a sitting president will get re-elected, or a lame duck president will have someone from their candidacy get elected, is like zero. Doesn't happen. So, you know, we have this big payroll report number, and then we back off the trade war. So you kind of get the idea that, is there something he knows that we don't know? Now, of course, there's lots of things he knows. He has access to all the heads of all the major companies. His cabinet has access to all these people. Is there something bigger coming soon? I thought, okay, well, is there something in the retail sales data today that showed, as I expected, retail sales to slow down? Is there something bigger coming that he was forced to back off because if a recession does hit, he wants to divert the blame to whatever it is and not make it the trade war? It could be. I mean, the Fed is panicking. They announced that they're going to dump or make available an extra $365 billion. Some people say as much as $500 billion of dollar loans available in the next 30 days. Starting Monday, they're going to increase their dollar lending limits. We know there's a liquidity shortage because of what the Fed tightened. World dollar liquidity is shrinking the number of dollars in the global economy. But there's a lot of liquidity in a very short time. Is that what President Trump knows? Is there something else? Is it just some intuition of more things to come? I don't know. But I don't think we have the deal that people think. I think there's something more here. And from an investment standpoint, you know, you look at the stock market. What has fueled the stock market for practically 2 years? Trade war optimism. It's gone. It's over. This is it. Oh, yeah, there's going to be a phase 2. I will tell you this. If you look at what was to be discussed in phase 2 and 3, they will never happen. They're intended to be these long, drawn-out conversations that never get anywhere. You know, we're fundamentally asking China to change how their economy works. That's a lot to ask a country. It'd be no different than someone coming here and asking us to fundamentally change the U.S. economy. It just doesn't happen. So is something bad coming? I don't know. Anyways, let's go and take a look at the charts. Kind of weird not reading the disclosure. I'm saying that to remind myself to read that. The M2 money supply growth rate was down slightly to 7.29% from a year ago. 6-month rate of change is kind of, I don't want to say it's rolling over, but at least it's falling. And the 3-month rate of change is falling, but they're still running really hot. I mean, these are big numbers. But where is this money coming from? We'll go look at that. Well, maybe we'll look at it a little bit. It's mostly in institutional money market accounts. So taking a look at the St. Louis adjusted monetary base, this is a repeat slide because I forgot to hide it. But as of December 5th, the monetary base is barely up $20 billion despite $300 billion of easing. Effectively, what this is saying is the Fed's policies aren't working. There's a major leak of dollars in the global economy, and the Fed is trying to plug it, and they're not being successful. So looking at real estate loans, which had a huge move last month in terms, I mean, not huge, but huge compared to recently. So there was a lot of loans right at the end of November, kind of got some people thinking that perhaps this is a resurgence of the real estate market. Doesn't appear to. Growth rate is up 4.32% from a year ago, just slightly. The 6-month rate of change slowed to, or fell to 2.02. 3-month rate of change is at 1.42. Historically, these are very low. I mean, the amount of loans is still below. The growth rate is still below prior cycles. So it's not a lot of strength there, but it's where there is strength. Commercial industrial lending growth rate slowed down to 2.73% from a year ago. The 6-month rate of change is now flipped back negative, and the 3-month rate of change is still negative, but not as negative as it was. But overall, you can see this thing is making a quick move on the year-over-year rate down to 0, and that's not good. I mean, usually at this point, you can see we are or should be in a recession. And looking at all the loans and leases at all commercial banks, making up about a third of the total lending market, the growth rate was up slightly to 4.74%, whereas the 6-month rate of change is at 1.82 and the 3-month rate of change is at 1 and falling. All this tells you is when you factor all types of loans, lending growth is weak. So if you look at the bond market, you should not expect to see higher interest rates or higher treasury yields, nor if you do see higher treasury yields, they're not sustainable with this lending growth. Consumer credit card growth, this rebounded back. This was bound to pick up the spending from Black Friday at some point. So it's up 4.02% for a year ago. Still very, very weak. So that's it for those charts. Let me go and load up the next things we're going to look at. And let's go to the Fed H.8 assets and liabilities of commercial banks. So again, everyone thinks that interest rates are going to the moon, but large commercial banks added $15 billion of treasury securities. You could see $9 billion went in government insured debt, with $7 billion in mortgage-backed securities, and it looks like $5 billion in U.S. Treasury securities. So again, even this recent bump higher in interest rates, who is buying? The banks. The banks are buying in big ways. Not much change here in non-government insured, up $3 billion there. But let's take a look at loans and leases. We can see 9.997 trillion, 9.986 trillion. So a decrease in December 4th. That's not a good sign. Led by commercial, and not just by commercial, but you have commercial lending decreasing by 5 billion. Real estate slowed by 2 billion, decrease there. You see residential real estate loans, big drop after their big jump. So I was wondering if that was going to get revised lower. Consumer loans up, looks like 5 billion. So not a lot of strength going on here in the lending market. Let's take a look at the NASDAQ McClellan Summation Index, and we've got it just peaking here. And of course, the market wants the price, the stock price to go higher, but liquidity is not there. Again, we're looking for a big, deep reversal in this before we get out of bonds and back into equities. This is not the time or the place if you're looking to buy stocks to do that. Let's take a look at the M2 money supply, but what I want to do is go pick up a specific piece of the M2, and so I wanted you to see where I got that from. I just went down here to the H.6 money stock measures, and you can see institutional money funds, big jump from the preceding period and over last year. Well, if you click on institutional money funds, you get the institutional money fund chart. And what you can do, you can have some fun with this. And one of the things you can do is you can invert it. And why would I want to do that? Well, because when money is in cash, it affects the broad interest rate market. So if we go here and put in 10-year treasury yields, we'll add that data source, and we'll go over here and we'll right justify it. And you can see, based on this move down, this rise in money flowing into institutional money market funds, which is now showing upside down inverted, it's putting a limiter on interest rates rising. So you can see the market is trying to push interest rates higher. If we zoom in, you can see 10-year treasuries trying to go higher, but if you look at compared to institutional money funds, it's saying forget it. There's money flowing into cash. That brings yields down across the board. So just kind of, something else you can look at to kind of get ideas is there reflation here? The answer is no, there's not. So let's talk about what's coming here at the end of the year. Oh, you know what? I realized I closed my disclosure sheet. I can't forget to do that. So starting on Monday, there is going to be some concern that this dollar liquidity crisis is going to happen because corporate, not estimated tax, the corporate fourth quarter, maybe it is their version of estimated taxes, that is due on Monday. And so the Fed is getting panicked over a potential dollar liquidity crisis, which they should be because they created one. Neither here nor there, but it is their doing. So they're going to put a lot of liquidity in there. Now there's, as I mentioned on Wednesday, there's this thing called GSIB, and the GSIB score applies to the very largest of our commercial banks. And there's this notion that they're going to be selling to bonds to bring their score down because stock prices are so high. So there's a couple ways to look at. One, they don't actually right now care that their score is going to require them to put in more excess reserves because maybe they want more reserves. The other notion is that the banks will somehow need to either get the stock price or get stock prices to go down or get interest rates to go higher. We have no evidence. Not only can the economy handle higher interest rates, but the banks are selling. We just saw the first week of December, they are still buying Treasury securities. So if they were looking to sell them, you'd think we would start to see that. And we don't see it in the price charts. We don't see it in the underlying data. We see a demand for cash and bonds. So why would the banks go selling? I don't know. But nevertheless, I'm not sure that's going to happen. Maybe without the trade war now driving stock prices, we should see perhaps stocks start to work around the economic data, which is not conducive for stock prices at all. But let's go and take a look at the data that came out today or yesterday, the producer price index. You could almost predict this by taking a look at durable goods new orders, excluding defense industries and excluding non-defense aircraft and parts. So, I mean, generally most consumers are out buying airplane or airplane parts. And you can look when you zoom in on a year-over-year rate of change, how close these are. So you can kind of guess that durable goods new orders are likely to still continue to be in contraction, and the producer price index is still running negative, but it bumped up a little bit. Taking a look at retail sales, which came out today, and you can see when new orders fall, retail sales should fall. We've looked at this. Right now, retail sales are running a bit hot compared to the value of durable goods new orders less defense and aircraft parts. But when it does get up here, like right kind of here in 2008, you can just see that durable goods, but retail sales were rising against falling durable goods orders, and you can see all of a sudden there was a big drop in retail sales. Do we expect that again? Most likely, yes. I mean, we're not seeing a turnaround in durable goods new orders. And then today you're kind of reading about, as we look to find out where the economy is going, you can look at the 4-week moving average initial claims or the unemployment rate, and you can see that during 2016 and 17, this was still falling. I'm showing this inverted so you see it rising. So claims for unemployment were falling, but look, since 2018, they're flat and starting to roll higher or lower because they're showing this inverted, meaning the number of people that are making initial jobless claims is slowly starting to rise. And when you look at the relationship between durable goods new orders, non-defense and less non-defense, or less defense and less non-defense aircraft and parts, we should see unemployment claims rising. So the question is, have employers been waiting for the trade war to end, thinking that that could be a turnaround? Will they be disappointed by the announcement today? I don't know. But you can see that normally these two have a very strong relationship. So as we see this roll down, because it's shown inverted, that means the number of new claims should be increasing. We saw that this week. 1 week is not enough to make a trend, but we should expect to see it. And when it happens, it's likely to be very quick, because look at how far durable goods new orders, less defense and less non-defense aircraft parts are leading this. We should start to see a lot of people hitting the unemployment line. That's what we should see. Whether or not we will, I don't know. But let's go and take a look at some charts, get that stuff cleared out of the way. Oops. All right, so despite all the hope of a trade deal, stock investors only seem to be excited about the hopes of one. And as you can see today, an actual trade deal wasn't very exciting to them. Perhaps it wasn't the deal they thought. I don't think many people expected this, but it was a farm package from the beginning, and without any details of how it's going to be controlled. Let me just put it this way. China is agreeing to buy, I'm hearing rumors between 50 billion to 32 billion. We'll just stick with 40 billion. Seems to be the most popular number out there. If China's going to buy 40 billion a year in ag commodities, well, that's impressive considering last year they only bought 10. And the record they've ever bought in 1 year is 26. So do they need it? Where are they going to go? Are we selling it through China just to make this look good? The bad thing about this, whatever this trade deal is tracking shipments in ocean bearing vessels is easy to do. So when you pick up ag commodities from a port, you list where you're going. And if you don't list where you're going, someone will eventually figure it out and put you down. So we'll know what's going on there. So, but investors weren't very excited about the market today. And looking at treasury yields, we can see 10-year treasuries ran right up into resistance last night and were rejected at resistance. This is a positive sign when you're rejected, in fact, strongly rejected at a zone of resistance, where this is where people are buying treasury securities. It tells you there is a demand to purchase here and that yields will go lower. So we want to see, because we're bullish on bonds, a breakthrough on the 10-year of around 1.7%, which we have to assume based on today's reversal that it will likely make a run at 1.7. After all, the economic data is very supportive of lower interest rates. I mean, if you looked at the economic data just this last week, there was virtually nothing you would find that would tell you interest rates are going higher. 30-year yields went up and closed a gap here. There's a gap here that appears to be remaining open. Remember, I told you these gaps do get filled, sometimes right away, sometimes not. Well, here it is. The market went and filled that gap and filled all the little gaps that were in here and has left two gaps. I know, it's ridiculous. We've got a gap right here and right here to add to all the other ones between where we're at now and the all-time lows, where there is a gap right down in here. So again, still from just a charting standpoint, yields are still looking to head lower. The economic data tells you they're headed lower. The lending data tells you they're definitely headed lower. And what we want to see for 30-year yields is get through these just double bars where I got these two purple lines. This is a heavy area that's acted as now both support and resistance, and we want to see it break through here and start to move all those people who are short treasury, especially all the hedge fund managers, start to unwind their positions, bring those quantitative computer models that sold back in and buying, and get a run and push through the all-time lows and trigger a bull market breakout in bonds. That's what we'd like to see. And again, the data is conducive of that. Let's look at TLT. 20-plus year treasury bonds, we see it ran up to its 50-day moving average, got rejected, but again, closed over this lower level of support here. And again, every time it's closed over this, it's kind of made a run at that dotted line, which is roughly those two bars on the yield chart. So we'll expect at some point to get another knock on the door here, because right here, this level of support, there are buyers here. We're seeing nothing but buyers here. And we know where the sellers are at this dotted line. The question is, can the sellers keep selling? Because the buyers are doing real well, and you're not seeing on these move down a lot of selling volume. So you're seeing price move down, and then you see how the candlestick is green. That means the price was lower and buyers came in. Price is lower, buyers came in. Price is lower, buyers came in. So you're seeing buyers all through here. Just a matter of pushing through those short positions. And speaking of kind of the trade war for one last time, you would think ag commodities, on the idea that there would be 4 times this amount purchased over last year, would send them higher. And it got right into the zone of where previous sellers were at, and sellers came in and sold. So you can see the market is not sold on the trade war, but this recent pattern is bullish until proven otherwise. So as long as we keep seeing buyers continuing to nudge prices up, there is still product out in the fields that has not been harvested. Hard to believe, but due to the weather, it has it. So let's see what other charts we want to look at. Again, I haven't looked at any of really these for a couple hours. We see some okay trading volume on the S&P 500, and let's just look at how it went. I mean, just flat after all the news, really didn't do anything to speak of. Let's take a look at oil and gas producing stocks. There's all this bullishness over the OPEC meeting. It really is a dud. They're not going to cut that much, and oil supplies or products are supposed to expect to continue to build into next year. And people are still wanting to bid up oil stock prices, but they ran into resistance at the 100-day moving average, and there's really nothing to tell us that there is a bullish narrative when you have a continued crude oil builds and product builds. Bullishness will wear thin when you realize that demand is falling. Taking a look at junior gold miners, they're still right in an area where sellers have been selling. Again, I do expect this to come down and break through the buying support. Not much. A lot of trading volume in emerging markets. Don't know why. Gold, we looked at that already, kind of through the gold miners. So, all right. So, with all of that, So we're going to finish up early just because I just didn't have all the charts like I've had before, but that's okay. So just from a procedural standpoint, next week there may not be any videos. Every 3 years I actually go on vacation for 1 week. That's true. You're like, you only take a vacation every 3 years? Yes, it's true. And for those of you that also know, my wife has been through a lot of major surgeries in the past 15 months, been a successive pattern of going off all the drugs her doctors put her on, going through all the withdrawals. So she's starting to finally feel a little bit better. So the time of this, maybe get her out and away from the walls of her house that she's been looking at, get her some sunshine. Maybe that'll help her spirits going into next year, where we know she'll probably be under the knife one last time. So I'm going to take my laptop, my microphone here, and I'm going to try to record videos, because apparently I'm told the internet where I'll be, it should be able to handle the uploads. But in the event I cannot figure it out or it doesn't work right, just so you know, there may not be. Otherwise, I'm going to go make the effort to produce the videos. There may not be in a camera view just because my camera on my laptop's not good, but just give you a heads up, that will be next week. I will have full access to pretty much everything else. So if anything, I'll be watching the markets during the day, and if something needs to be done, we'll do that. So anyways, appreciate you taking the time to watch. The content of this video is provided as educational information only and is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation to buy or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in my own personal capacity. The opinions expressed in the video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Hope you have a great weekend. Thanks for watching. Bye now.